In the general lesson on accounts, we looked at the options common to all account types. In this lesson, we will look at the additional options available for fixed-rate income accounts. We've included this account type to cover some special situations that can't be handled by managed accounts, annuities, or bank accounts. This lesson looks specifically at these accounts. Fixed income accounts are a hybrid of the other account types. Like annuities, they can define a specific income amount for each year. But unlike managed accounts and annuities, they are not affected by bear market simulations. They also have some special rules for calculating year-end balances. One use for fixed income accounts is to model single payment immediate annuities, or SPIAs. SPIAs generally provide a fixed income for the client, either for the life of the client, the life of both clients, or over a specific range of years. Another time to use a fixed income account is for interest-only income accounts. For these accounts, the account rate of return will be projected, and that amount will be withdrawn as income each year, leaving the balance at a fixed amount. For example, the client may wish to deposit $100,000 in an account that earns 4% interest and withdraw that $4,000 in interest each year, leaving the balance at $100,000. This type of account can be modeled as a fixed income account. Simply set the yearly income amount to match the expected interest on the account and set the rate of return to the same expected rate. OptiPlan will add the interest to the account each year and then subtract the same amount as income, leaving the balance fixed. This is a slightly different calculation process than the other account types, which conservatively subtract the yearly income before applying the rate of return. For fixed income accounts, the rate of return is applied before the withdrawals in order to keep the balance constant. After defining the common attributes for the account, we can move to the remaining fields for this account type. The yearly income attribute is used to define how much income the account will pay each year. The yearly income increase parameter is used for accounts where the income increases over time. If the account provides an income that increases each year, enter the yearly rate of increase in this field. The income will be automatically increased by this percentage each year, starting in the second year. The signing bonus attribute is used for single payment bonuses paid by the account provider when the account is opened. This value is entered as a percentage that the account provider will add to the initial balance when the account is first opened. Do not use this field if the account has already been opened and the bonus is already included in the current balance. The rate of return parameter is used to estimate the rate at which the account is expected to grow. Keep in mind that this is a hypothetical rate of return based on past performance and investment strategy and may not be guaranteed. The rate of return is used throughout the account lifetime, as these accounts are not affected by the bear market simulations. The management fee attribute defines the percentage that the account manager withdraws from the account each year as a management fee. The account balance will be decreased by this percentage each year of the plan. If the management fee is already factored into the income amount, you can leave this field blank or set to 0. The percent to survivor attribute defines the percentage of the income that this account will shift to the surviving spouse when the account owner dies. In many cases, a SPIA will not have a death benefit, meaning that the income stops upon the death of the owner, and no balance will go to the heirs. In these cases, be sure to set the initial investment amount to 0, since the account has no balance to draw down. The account will pay the specified yearly income, but will not contribute to the overall portfolio balance. For SPIAs that do have a death benefit, the amount paid to the beneficiaries is usually just the initial investment amount, minus the payments that have been made to date. To model this in the scenario, create the account as a fixed income account and set the rate of return to 0%. The yearly balance to the heirs will simply decrease each year by the income amount. If this does not create the desired behavior of the account, you can set the rate of return to a higher value. There's one additional note to keep in mind for this account type. If the income is not for the client's lifetime, be sure to enter the appropriate value in the last income year field. If the income will stop when the account owner dies, be sure to set the percent to survivor field to 0.